Hello everyone, this is Manchula Devi P, working as Assistant Professor in GFGC Kanakpura. So in this session, I would like to discuss about valuation of bonds. So how the bonds are valued or what are the different concepts of bonds is all the subject matter of this video. So when we talk about valuation of bonds, there are different concepts of value. Okay, similar as like when we talk about profit, there are many versions of profit. There is gross profit, there is net profit, there is operating profit, there is profit before tax, profit after tax. So many concepts of profit, isn't it? Same way, when we talk about bond value, there are many versions of value that we can come across. Let's see one by one. First one, we have something called as book value. What is the meaning of book value? So, book value is if you find out the net assets, that means the total the assets minus total liabilities, and then you'll get the net assets divided by the number of shares. If you take, then you get what is the book value of each bond or each share, then that is called as the book value. Very simple to find. It's basically it is based on the concepts of accounting concepts and the valuation that they have made for assets and liabilities by applying the rules of double entry, by following the accounting policies and principles. That is book value. Then we have something called as market value. Market value purely depends on the demand and supply of that bond in the market. So it keeps changing. So it represents what is the value at which the bonds or the securities are presently dealt in the market. As I said, it depends purely on the demand and supply of the securities in the market. Then we have something called as going concern value. Going concern value means this is the value that you can fetch, or that each security can fetch if the entire business is sold to somebody as an operating business. Okay, so if what is the value that the buyer is ready to pay per share or per security if the entire business is sold to somebody as an operating business, then that is called as the going concern value. Then we have something called as liquidation value. Liquidation value means it is different than the going concern value. If you are liquidating the business or if the company is getting wind up, in such case, once you sell all the assets, then whatever the money you get out of that, you clear all the liabilities, then whatever the value or amount left, that you divided by number of shares, then you get the liquidation value. Always going concern value would be higher than the liquidation value. Then we have something called as replacement value. So this is the value that has to be incurred or that has to be paid if you are replacing the asset or the security, the present value that at which it can be replaced. That is called as the replacement value. Then we have, last but not the least, the most important concept of value, intrinsic value. Because next chapter or next units when we discuss, we talk about fundamental analysis and technical analysis sort of things. So the main concept or idea of doing all this analysis is to find the intrinsic value of the share. It is also called as the true value. Okay. So what is this? So intrinsic value represents the true value of the share or the security after considering all the factors which matters for valuation, like by taking the cash flows that the company can generate, by taking the demand and supply that can arise in the market, by taking the going concern value that can arise. Okay, by taking all the values into consideration, by applying so many statistical data, by seeing the trends of the shares over the past period of time. So by considering all that, and there are different theories also to find the intrinsic value. So when we calculate the value, that is called as the intrinsic value or the true value of the share. So what could be the future value of the share, or at present what is the value of the share if we consider all the factors which matters for valuing the share, like its book value, its market value, its going concern value, what is the cash flow position of the company that is discounted at present value. So if we consider all that, then we find out, then that is called as the intrinsic value. Anyway, there are many theories which explains how to calculate the intrinsic value. So anyway, we'll discuss in detail about the various theories which we apply for calculating this intrinsic value. So again, different theories may result in different intrinsic value. So whichever is apt, or whichever is feasible for that company at that point of time, can be used for valuing the shares or bonds. Then coming to the valuation of bonds. So how do we value the bonds? So we can broadly categorize the bonds or securities as two categories. First one, bonds with a maturity period. The second one, bonds which are perpetual or perpetuity bonds. Let's see what is the meaning of maturity period bonds. So here in the previous sessions we have seen, maturity period is one of the key element of the fixed income securities. So the bonds which has a fixed maturity, definite maturity period, like 5 years, 6 years, or whatever the number of year, such bonds are called as bonds with maturity period. So in such case, we find out the present value of the bond by adding up the future cash inflows that can be generated by the bond plus the maturity value of the bond. Just to make it simple, suppose if I have invested 10,000 in a company's debenture and the company offers me 1,000 interest every year, and if I have invested, the maturity period of the debenture is say 5 years. So in such case, what is the present value of the bond? I would consider all the cash inflows that I can receive in future, like I receive 1,000 every year for next 5 years, plus at the end of 5th year I will also get my investment back. Yeah, when they are paying me back, they can add the premium or they can pay me at the par value itself, depends. So what is the value that I'm going to get back at the end of the maturity period? If I sum up all of this, the cash inflows that I can receive plus the maturity value, with discounting that to the present value, like 1,000 what I receive at the end of 5th year may not be same as 1,000 today, or 1,000 I receive after 3 years, the value of it may not be same as 1,000 today. So I have to apply the principle of discounting. I discounting all the future cash inflows that can be generated with the security or with the bond, convert it to the present value, then that represent the bond valuation as per this logic. So there's a simple formula. So you can take P means the present value of the bond is equal to summation of C by 1 plus y to the power of t plus f divided by 1 plus y to the power of t. So here C is the periodic coupon payment. I said I'm going to receive 1,000 interest every month, every year, for example. So that 1,000 becomes the coupon rate or C here in this case. Then Y is the yield to maturity. Yield to maturity means the coupon rate, like 10%. That 10, or I usually write as 0.1 there. The 10% or the rate at which I am going to receive, Y represents the rate. Then F represents the bond's value, the value that I am going to get after the period. Maybe it may be a par value, or it may be with premium, or whatever the actual value I am going to get it back with the principal amount. Then T represents the time. So for the first year I take 1 plus y to the power of 1. For the second year I take 1 plus y to the power of 2, so on. So here T represents the total number of periods until the bond's maturity date. That means at the end of 5th year I am going to get. So that for the face value recovery, so I use the last year. I take that as 5. Anyway, if I explain with example, it would be clear to you. But it is same concept as if you have studied the discounting principle, it is the same. If they have given the discount factors of each respective years, you can multiply directly, or you can use the formula for discounting the cash flows into the present value, and then you can consider. Then we have perpetuity. Perpetuity means the bonds without any maturity period. Okay. Such bonds are called perpetuity bonds. They give you returns perpetually. Like you are investing some money and you are going to get the returns forever at a fixed percentage. So how do we value it, as there is no maturity period? The concept is very simple here. Value of the perpetual bonds is equal to D by R. D means the rate at which the bonds are giving you the yield, the rate, whether they are giving you 10%, 8%, 12%, whatever the rate, divided by the discount rate applied. D represents the coupon interest. So whatever the amount of fixed return that you are going to get, if you are getting 1000 every year, so I take 1000 there, divided by R represents the rate that is being applied there, discount rate which is applied on the bond. So now let's take one example, because with example the concept would be clear to you. Let's take one example of the maturity period, bonds with maturity period. An investor is considering the purchase of 8% rupees 1000 bond redeemable after 5 years at par. The investor's required rate of return is 10%. What is the value of the bond? So he is investing at the rate of return of 8%, and after 5 years he is going to get the investment back at par. That means they are not adding any premium to it, they are just paying that 1000 back to him, and he expects a return, he requires a return of 10%. So in such case, what is the value of the bond? So first let's calculate what is going to be his C. C means the annual return that he is going to get. If he has invested 1000 and if he is getting 8% on it, then he is going to get 80 every year. So C is equal to 80. So we have C1, C2, C3, C5, because for 5 years you are going to get this returns. Then the face value. So they said that it is going to be returned at face value. Face value is 1000 and he is going to get 1000 back. So it is 1000. Number of years, it is 5, and his expected rate of return. So he wants a rate of return of 10%. So I can write it as 0.1. 10 divided by 100 would give me 0.1. Now let me put it to the formula. Okay, the formula was summation of C by 1 plus y to the power of t plus f divided by 1 plus y to the power of t. So that means basically I am summing up all the cash inflows that can be generated from that bond. So now I am taking 80 I am going to get for 5 years. So I am taking 5 times 80 divided by, for the first year 1 plus 0 to the power of 1. For the second year 1 plus 0.1 to the power of 2. So likewise I am taking for all 5 years. Then at the end of the year, at the end of 5th year, I am going to get the principal amount back at par. There's no premium added, so I'm going to get 1000 back. That too at the end of 5th year means 1 plus 1 to the power 0.1 to the power of 5. Now if I simplify, if I sum it up, I am getting the value of the bond at present as 924.2. That means if you are a seller, if you want to sell the bond, so minimum you should sell it for 924.2. So if you are if you get any amount more than this, that means you would have a gain on the value of bond. Okay, so let's see one perpetual bond. That's very simple. Perpetual bond, Mr. A has a perpetual bond of the face value of 1000. He receives an interest of rupees 60 annually. What would be its value if the required rate of return is 10%? So it says he has a perpetual bond and he gets 60 annually for, there's no maturity period, forever until he is alive. Then what is the value at which he can exchange that perpetual bond? So the formula is value of perpetual bond is equal to D by R. D is the annual return that he is getting, that is 60 in this case, divided by R is the required rate of return. So here it is 10%. So the answer would be 60 by 0.1 would give me the value of the perpetual bond. That is, the present value of the perpetual bond is rupees 600. So if he gets 600 or more than that, then he can exchange the bond. Okay. So this is about perpetuity. Hope you have got the concept and the formula as well. Just to have a quick recap, what we discussed in the entire session. So bonds usually carry a coupon rate and also a fixed maturity period. So there it can be a maturity period or it can be without maturity. Without maturity period is called as the perpetual bonds. So value of the bond with maturity is the total value of the interest receivable plus the present value of the bond at the time of maturity. If I sum up all the cash inflows that I can receive from the bond, convert it to the present value, then that gives me the bond value with maturity. For perpetual bond, the logic is very simple. The amount that you are going to receive divided by the expected rate, D divided by R, would give me the value of the perpetual bond. So these are the some references that you can refer for your further studies. Please see the old question papers and look for the type of question, the type of adjustments they are giving for calculation. So hope I made the concept clear. Thank you very much. Let's meet in the next video.